Hi guys, focus for today is to look at money market edge. That's what we're going to be looking at today. And remember where we're coming from. We're looking at how to manage foreign exchange risk. And we said we can use both external or internal. For external, you either use the bank services or you use derivatives. And for bank services, you can use forward or money market edge, which is the focus. We've looked at forward in our previous question and videos, and today we're starting with money market edge. Yeah, this is a bit different from forward, and I need you to pay attention to this. Yeah, don't find it very complicated, but it is not as complicated as it looks, and I'm going to break it down into steps for you, which you will use to practice. And after several practices on that, using those steps, you will be very, very comfortable. Right, so money market edge, I will summarize it into a method, that involves, just note this, involves the use of, number one, note the short-term investment and borrowing. And this is coming from the word itself, money market. These are called money market instruments. Any short-term investment or borrowing is what is actually referred to as money market instrument. Yeah. So you see that some government have such treasury bills, commercial papers, short-term deposit, short-term borrowing, interbanks. Yeah, all those are money market instruments that can be used. So you will discover that as we move on, we will have to borrow and we will have to invest in this method. In order to manage our FX rate, we must borrow and we must invest. I'll teach you how we do it. Another thing you must know is that it uses late payment. And I told you earlier that late payment means immediate payment, immediate conversion. So that is what you must note about this. So we don't wait into the future, we do immediate conversion. Excuse me. We always do immediate conversion. So this involves immediate conversion at spot rate, always. So we're going to be using spot rate. We don't use forward rate in this one. Yeah. And you will see how this is done. So we convert today. We'll try to remove the time delay such that there is no exposure to fluctuation in exchange rate for this. Yeah. And generally, I need to tell you for the exam's sake. So these are the two things we'll be using. But for exam's sake, they will always tell you that, most times they will tell you that this assumption holds. And what is that assumption? No excess cash available. Because if they don't tell you this, it means that you might not have to borrow in some instances. But most times they will tell you that there is no excess cash available so that you can borrow money, right? Because you need to borrow, and it depends on what is going on with you, what you want to do to know whether you need to borrow in your currency or in foreign currency. But I'm going to teach you now. So I will break it down into two for you. You remember we are dealing with FX, foreign currency. So which means it's always either you are paying FX or you are going to receive FX. So there are always two circumstances. It can never go beyond this. It's either you are receiving FX in the future or you are paying FX in the future. So you have that exposure. And that's the exposure you want to manage using money market hedge, right? But the way you want to do it, you want to use money market as such that even if you are going to receive FX in the future, you want to make sure you do immediate conversion, using investment or borrowing and using money market instrument, such that your delay to receive this FX doesn't have any impact on you. And your paying of FX in the future also does not have any impact on you in terms of foreign exchange risk. So what are the steps? I've broken it down. First thing you must determine is your objective, please. And let me tell you how you know your objective. If you're going to receive FX in the future, what it means is that you have an asset because it's a receivable. If you're going to pay in FX in the future, it means you have a liability because it's a payable. So your objective must always be to create the opposite of what you have. Yeah? Your objective is always the opposite. Yeah? And what is the opposite? It means you need to create, for this one where you have FX asset, you must create FX liability. So determine your let's not call this your objective so that it's clear. Let's call it money market edge objective. Money market edge objective. That's the first thing. Yeah, same thing we're going to do here. Determine the money market edge objective. And remember, it's the opposite of current situation. To make you remember. And here, that is number 1, create FX liability. So for this one, its own number 1 will be to create, because there is FX liability as current situation, then we need to create FX asset. I'm going to use question to explain this, but I need to build the structure with you so that we'll now use the structure to work the question. And with that, you'll be home and dry. So to achieve this, let's go A. You need to determine amount, amount of FX liability that you need to create, because it's not going to be the same amount. And I'm going to show you as we work a question. This amount is very critical. Because the fact that you have FX asset of $20 million, for instance, doesn't mean that you need to create a 20 million liability. In as much as that is your ultimate goal, but the amount that you need to create initially is not always the same amount because there will be interest accrual, right? So I will work all of that with you. Just take it one step at a time. So you need to determine the amount. The amount of FX liability must be determined. And likewise you need to determine amount of FX assets. So it's about the amount first for once you know your objective. Then once that is clear, you go to the next step, which is now, because we need FX liability, but we are a local company, we need to borrow, right? So once we know the amount of FX liability that we need, then we can go ahead and borrow it. So the step 2 is to borrow the FX amount. That is from step 1. Borrow the FX amount from step 1 and convert it immediately. So at spot rate. You see, everything is happening today, so there is no delay for the future. So we'll convert it at spot rate to local currency. And then lastly, we can accrue interest on our liability. So we accrue interest on the liability. This liability in step B. Okay, so this is step 1A here, right? So, and that is it. Similar thing we'll do if we are paying FX in the future, but opposite. So once we know our objective, currently we have a liability, then our objective has to be to create an asset. So then we say A is we need to know the amount of asset we need to create. Very important. And once we know the amount of asset we need to create, the next thing is we cannot go and borrow another FX to create this asset because we already have a liability. So if we go and borrow again, then that means we're having two liabilities in FX. Then we have not helped ourselves. So which means we have to borrow in local currency to create that FX asset. So first of all, we have to borrow in local currency. So once we borrow in local currency, then we can now convert to FX again at spot rates, to achieve that A above. So we need to make sure that we borrow in local currency in a way that we're able to achieve that amount of FX that we need. So, and I'll show you how to work all of that out in terms of calculation. But our objective is to determine how much of asset do we need, right? Today, everything happens today. How much asset do we need today? Once we know the amount of FX asset we need today, then we'll ask ourselves, how much of our local currency will be equivalent to that asset? Then we can now borrow that. And once that is done, the next step is to, similar to the other side, is to accrue interest, because we must always accrue interest on our liability. You see that the steps are almost similar but opposite. So look at them, it's similar. Once you just understand the steps a bit, the calculation will come immediately after this. We use the steps to practice it. You can take a picture of it just for you to save. It's good. And keep it on one side when you're looking at the calculation. So that is the steps that we're going to be using. Usually what the question always asks you to do is to determine amount spent. So usually at settlement date, you need to be able to tell. So at settlement date, on each side, for this side, we're talking of receiving FX. You need to be able to determine total amount received in local currency. It's very important. Remember, this is usually happening in the future, maybe in 1 month's time, in 2 months' time, whatever period it is, after doing all the calculation. This FX that has now been received and closed out, what does it amount to using this method in local currency? Similarly, on the other side, you must be able to determine the total amount spent to settle that liability, but in local currency. Amount spent in local currency to settle the liability, to settle the FX liability. Usually this is what the question will ask you when they are testing money market hedge. Another way they can test it is to say which method should they use as a company. Should they use forward or should they use money market hedge? This is what you need to calculate, because you will now check using this method and using the forward, which one is better. If the amount spent is cheaper here, then you use money market. If the amount received is more for money market, you say use money market. So that's what we're going to be doing, and I'm going to work a question